Hello, welcome back to Weekly Market Recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. So this past week, we saw the S&P fall 5.05%, brings us down 18.16% year to date. The NASDAQ fell even more, 5.58%, which brings us down 27.52% year to date. Now, for the most part, we were actually not that down until late Thursday and then Friday. And the biggest issues we had was CPI reading, which we'll get into for the lion's share of this conversation, but also the Michigan U.S. Consumer Sentiment Survey came out as well. And that was kind of a 1-2 punch on Friday. But if we jump into what we see in the market, we actually see that we started to rise on Monday, a little bit of volatility, choppiness in the week, but nothing really until all of a sudden we got to the afternoon on Thursday and we just started to fall. And then we get obviously on Friday, this just opened massively down after a really bad CPI reading. And then we started to trend back up. And what happened? We got more bad news, specifically around the US consumer sentiment, and we started to fall again. So those are the two areas that we really saw. Again, we started to maybe start to peak up, but then right in the last hour of trading, we also fell dramatically. So let's talk a little bit about what happened with CPI. So we were expecting around 8.3% year over year. We had a miss to the high side of 8.6%. We were expecting 0.7% month over month, and we got 1% inflation month over month. And the biggest reason why this was so shocking to the market is two reasons. One, we were hoping that we had reached peak inflation back in March, and we were going to at least start trending down. We were trending down in April, and then all of a sudden, May data came out, and we were 8.5% back in March, and we just got a headline number of 8.6%. That means we're going in the wrong direction. In addition, on the month over month side, we were all the way down to 0.3% last month, and now we're at 1%. So again, that's going in the wrong direction as well. And so it's really alarming and stirs up a lot of fear of, okay, how much of this inflation is being more and more ingrained? Because again, this month, some of the biggest impacts were more on the housing side, and housing is a lagging indicator. But if housing is going to keep us running hot on inflation for the long run, we might see again, high inflation a lot longer than initially expected. Also on the inflation reading, if we jump into some of the numbers, this is the graph that I was talking about on the month over month. And again, what we see is we were trending up, had really bad March data. April was good again. Now, a lot of this headline was due to food and energy, but we saw food and energy start to drop, and then all of a sudden it was back up. So one of the biggest components too in this past month was, again, food and energy started to spike again, but really just almost every single category, we've been seeing higher prices. And so we got this data again right before market opened, and then we had the 1-2 punch of the Michigan Consumer Sentiment Survey, and we were expecting around 58, a little bit lower. Last month we had 58.4. This month we were expecting 58.1. We got 50. Now, if you're under 50, that's bad. Most people are afraid of the market. Again, it's at the point where more people are afraid or think they are in a worse position than better. It's been very rare that we've gotten under 50. So the fact that we missed by 8 points is a massive miss and a really scary position that we are on. So again, we had really bad inflation numbers. Then we had really bad consumer sentiment. One of the other fears around it is this consumer sentiment survey came out, all the data was before we even had this most recent really bad reading. And now people might have been feeling all the same issues that were in this consumer price index, and that's what they were referring to. But the other area in the University of Michigan survey that's measured is what is the 5-year expectation in inflation. And that ticked up as well. So instead of remaining flat or starting to go down, it's going up. And the issue with that is, again, the Fed's number one job is to fight inflation expectations. So if inflation expectations become ingrained or start to rise, they are going to have to raise rates faster. And if they raise rates faster, the market is going to feel more pain. That is just as simple as it can be. But right now we're in this position where we're really struggling to see, when is inflation going to come down? It's still possible that we could come down in the summer months or fall, but with every bad reading that we have like this, it's basically giving way to more fear that it's going to be more ingrained, it's going to take a lot longer, and the Fed is going to have to either raise interest rates way more dramatically or for way longer.
Very good points, Knight. I'm glad you were bringing that up. The other part that I want to just emphasize, and why the market dropped as much as it did today, and what Knight had said about expectations in the market doesn't like surprises to begin with. And a surprise to the negative side being both inflation being greater than expected and consumer sentiment being worse than expected is, as Knight said, this 1-2 punch. And to be expected, the market reacted very strongly to that.
So I think one of the main questions is what happens from here? And one of the big unknowns is we still have war in Ukraine going on right now, which is affecting both oil and food. So food and energy are going to continue probably in a stretch capacity until we have some more clarity there. One thing that has been a little bit more of a push recently is we have all these tariffs still on China that is just, again, extra taxes that are being pushed onto the consumer, making prices more expensive. There's being a larger push towards rolling back those tariffs that might help with prices. But the other really hard part is there's no full clarity, because if we look back 3 weeks ago, Walmart, Target came out and they basically said, hey, our inventories are getting way larger. We are struggling because we are actually missing expectation and lowering guidance because we have too much inventory. We need to start selling things for less. And so you have certain parts of the market that are feeling this over inventory, prices need to come down, but even with those prices coming down, it's not enough to offset the supply chain shocks that we are continuing to get with food and energy and COVID problems around China, more shutdowns. So it's this, even the potential good inflation news of, oh, some companies have too much inventory and prices need to come down, are still being offset with too much bad news globally because we have a war going on, COVID still running rampant, and really extreme shutdowns because of it.
Exactly. And I don't see that changing. We saw this back in the 70s. It is very difficult in a short period of time. And by that, I'm talking about more than just weeks, months, even 1 or 2 years. But let's look at 3 or 4 years for consumers to be able to change their driving habits, the use of fuel, and as a result, they get squeezed a lot. There is a big drop in certain consumable items, and we saw this in the 70s, but there's also this great demand for increased wages because fuel touches almost everything. If you think about it, most of our railroads and most of our trucks that deliver all our goods and services use diesel. Diesel is at the highest price it's ever been. So we're looking at shocks to our system that are very similar to what we saw in the 70s, and we're looking at a very real possibility of stagflation again.
Now, the best way forward from here is obviously to have a diversified portfolio tending towards quality, which is exactly what we're doing. We will be rebalancing portfolios sooner than normal this year in order to make these adjustments. So that's one of the areas that we are looking at. But it's a tough market to be in. There, we keep getting misses to the downside. The best thing that could happen to the market is for this war in Ukraine to stop and for COVID to stop having shutdowns. Both of those things are not really within many people's control. And the Fed, it's known that their policy implementation, it usually takes about 6 months to feel it in the market. So anything they're doing right now, we're actually not even going to see a big impact on the slowing of an economy until 6 months from now. But that's the problem, is that we're feeling it right now and we're not having any progress. We have to wait another 6 months. So it's hard when, again, all these things are not really in anyone's control to be able to adjust the underlying issues within the economy, but they are doing the best that they can from a policy standpoint. But it is really difficult and there's not a ton of clarity. And one of the biggest fears too is over tightening, sending it into a really bad recession, then taking a lot longer to recover. Now, Rich has mentioned how there's similarities between the 70s. One of the main differences that we are seeing is we still are seeing anchored inflation expectations, which is really strong. We had inflation expectations of over double digits back in the 70s. We don't have that, and we don't have a wage price spiral, which those are the two things that maybe the only bright side of this market right now, or this current reality, is that inflation expectations have stayed somewhat anchored and we're not seeing a wage price spiral. But we do start to see those things. It's a no-brainer that the Fed is going to have to Paul Volcker us again, raise interest rates above where inflation currently is. So what is Paul Volckering? If we're at 8% inflation, they would have to raise interest rates to over 10%. That it would stamp out inflation immediately, but it would send our entire economy into a deep recession. Now, maybe we could recover somewhat quickly. There's a lot of talking heads that can, really go into the nuances of that. But that's what Paul Volckering is. And that's what the Fed wants to be able to avoid at all chances.
Absolutely. And the other part that I would add to what Knight just said is, unlike in the 70s, we have a very strong employment situation. Employment was much weaker then, and we also were more dependent upon foreign oil than we are now. We do have some more control. So some of the issues we're seeing is just going to accelerate our economy to move further away from fossil fuel.
Overall, really hard week in the market. And I guess the only maybe good news is usually we have a lot of fear going into bad data. Once we get the bad data, there's a little bit more certainty. We're going to have the Fed come out next week. They're going to they're definitely raising interest rates at least 50 basis points. One of the new fears is that they're going to now raise interest rates 75 basis points. So we will continue to monitor that. If we get bad news there, I could see the market continuing this choppiness. But overall, we're here to support you. Your money's here to support you. Have any questions about what's going on, your portfolios, please give us a call. And we'll see you again next week.